Hello and welcome to Finance RM. This lesson we will talk about the topic of how to make money. So, core financial concepts. These are the physics of money, principles that govern how money grows, loses value, and moves over time. Without them, it's like trying to build a house without understanding gravity. Firstly, the time value of money, or TVM. It's a dollar today is worth more than a dollar tomorrow because it can be invested to earn returns. And it's like choosing between taking 50,000 today or 55,000 in a year. It's calculating how much you need to invest monthly to reach a goal. And a tip, always compare future amounts and today's value to see the real worth. Compound interest. The annual interest rate is 72 divided by it and the years to double your money. An example is that $10,000 at 8% doubles in about 9 years and it quadruples in 18 years. A tip, the earlier you start, the bigger the compounding effect. Delaying 10 years can cost you hundreds of thousands. Opportunity cost. It's the value of the next best alternative you give up when choosing something. Let's say you spend 5,000 on a vacation, you lose out not only on 5,000 but the 20,000 it could have grown into 20 years at 8%. Its use in deciding between paying off debt versus investing. Risk and return. The risk types include market risk, which is price fluctuations, credit risk, which is borrower default, liquidity risk, which can't sell quickly, and inflation risk, which returns don't beat inflation. Currency risk, which foreign investment exchanges return rates. And the concept is that higher returns typically require higher risk, but risk can be managed. Inflation and purchasing power. It's the increase in general price levels over time, and the impact is that it reduces the real value of money. At a 3% inflation, $100 today has the buying power of about $75 in 10 years. Always target investments that outperform inflation by 2 to 3%. Next, the income types and cash flow quadrant. The cash flow quadrant breaks down where your income comes out from and how to transition from working for money to having money work for you. So, the ESBI quadrant. Employees, self-employed, business owner, and investors. Employees work for salary. The pros have stability and benefits, but the con is that they're time-bound and taxed high, and their wealth potential is low to medium. A self-employed person owns a job. The pros are that it's flexible and more control, but the cons is that if work stops, the income stops, and the wealth potential is low to medium. A business owner owns a system, and the pros is that it's scalable and uses leverage, but the cons is that it needs leadership and capital, and the potential of wealth is high. An investor, money works for you. So the pros include passive and compounding, and the cons include risk and capital, and the wealth potential is very high. Goal, move from the ES to the BI for financial freedom, and try to check reality as 90% of people live in the ES and only 10% in the BI quadrant. Income categories, earned income, a job or service. Profit income, selling goods or services for more than cost. Interest income, lending money. Dividend income, company profit share. Rental income, real estate rents. Capital gains, selling assets at higher value. Royalty income, licensing intellectual property. And business systems income, franchises, scalable businesses. Active versus passive income. Active income is directly tied to the time worked, and passive income earns when you're not actively working. True wealth is the majority of income is passive. And the ways to make money is that every wealth building journey needs multiple income streams because one source is one point of failure. So the employment sector, the E quadrant, its leverage is build rare, high value skills. Its high income skills such as coding, negotiation, data science, AI engineering. And a tip, use job income to fund investments. Don't just inflate lifestyle. Then the self-employment S quadrant. The examples include freelancers, consultants, doctors, and lawyers. Its strength is that it's directly rewarded for expertise, but its limitation is that it's no scalability. Income stops when you stop. Business ownership, which is the B quadrant. Its models includes product-based, service-based, subscription-based, and its scaling tools include outsourcing, automation, and franchising. Investing, which is the I quadrant, is the stock market, which is growth and dividends, real estate, which is rental and appreciation, bonds, stable income, lower risk, and private equity, venture capital, high risk, high return. Digital age opportunities include e-commerce, content monetization such as YouTube or TikTok, SaaS tools, NFT and blockchain projects. Now, moving on to wealth management and growth strategies. Once money starts coming in, the game changes to keep multiplying it. Budget and cash flow. Remember the 50-30-20 rules. Needs, wants, savings. Zero-based budgeting. Every dollar has a purpose. And the cash flow formula is that cash flow is income, take away your expenses. And the goal is to have a positive cash flow and invest the difference. Next, your asset allocation. Its purpose is to balance growth and safety. An example is that 70% stocks, 20% bonds, and 10% cash alternatives. Adjust as the age and goals change. Tax optimization. Use tax deferred accounts, claim deductions, and time asset sales to minimize taxes. Leverage. Financial leverage. Use debt to invest. Time leverage. Delegate tasks. Skill leverage. Hire experts. Technology leverage. Automate systems. And reinvesting and compounding. Reinvest profits instead of withdrawing. Compounding accelerates wealth whilst withdrawal slows it. Mindset and advanced wealth concepts. Wealth is built 90% in the mind, 10% in the market. Delayed gratification. Spend less now to have more later. It's linked to higher lifetime success. Multiple income streams. At least 3 to 5 independent sources, and it protects you against job loss or market shifts. Net worth tracking. Formula is that assets take away liabilities, and you should review it quarterly. The financial independent number, with an example of if you have 40,000 expenses, then 4%, which is $1 million needed. A generational wealth. Assets that produce long after you. Teach heirs financial literacy, not just hand them assets. Lastly, we have financial risk and wealth protection. This includes the types of financial risks, core wealth protection strategies, inflation-proofing wealth, and estate and legacy planning. It's a psychological side of wealth protection, as the types of financial risks include the market risk, when investments lose value due to stock market declines, currency fluctuations, or commodity price changes. An example, your $100,000 stock portfolio drops to $80,000 after a 20% market crash. Inflation risk is the risk that your money loses purchasing power over time. The example is that if inflation is 8% and your savings account earned 3%, you're effectively losing 5% in real terms. Liquidity risk, the risk of not being able to access your funds when you need them. An example is owning property worth $1 million but not being able to sell it quickly for emergency cash. Credit risk, the danger that someone who uses and owes you money, borrower, bond issuer, won't pay. Legal and regulatory risk, losing money due to lawsuits, new regulations, or government policy changes. And operational and fraud risk, money lost due to theft, hacking, mismanagement, or scams. Core wealth protection strategies include diversification, which is spread investments across asset classes, stocks, bonds, real estate, commodities, crypto, and regions to reduce dependency on any single stock market. Don't put all your eggs in one basket is a literal risk reduction. Emergency fund, 3 to 12 months of living expenses kept in a highly liquid account to handle unexpected events without selling instruments. Insurance, health, life, disability, property, and liability insurance acts as safety nets. High net worth individuals also use umbrella insurance to cover large liability claims. Asset protection structures. Trusts, holding companies, and offshore accounts can legally protect wealth from lawsuits or creditors. Hedging, use financial instruments like options or futures to protect off potential losses in investments. Legal compliance include ensuring tax documentation and contracts are in order to avoid fines or legal disputes. Inflation-proofing wealth. Hard assets, real estate, gold, and commodities tend to maintain value during inflationary periods. Stocks in essential sectors such as companies in healthcare, utilities, and food often survive inflation better than luxury goods companies. TIPS, which is Treasury inflation-protected securities, as bonds that adjust interest and principal based on inflation rates, and income-producing assets like rental property, dividend-paying stocks, royalties. These maintain cash flow even when currency loses value. Estate and legacy planning. Wills and trusts determines how your wealth is distributed when you die, ensuring it all aligns with your wishes and avoids family disputes. Tax optimization using estate tax exemptions, charitable donations, and gifting strategies to reduce taxes. Succession planning. If you own a business, creating a plan for transfer of ownership or management. The psychological side of wealth protection. Overconfidence. Many lose protection because they understand and underestimate risks. Lifestyle inflation. As income grows, expenses grow, leaving little cushion. And chasing high returns. High return opportunities often come with high risk. Don't gamble your core wealth. The main takeaway is that making money without protection is like pouring water into a leaky bucket. No matter how much you pour in, it eventually runs out. Wealth protection ensures that your gains are secure, your income streams are stable, and your family's future is safeguarded. Thank you, and remember to be smart, stay smart, and achieve your financial goals. And don't forget to drop a like on the video and subscribe to the channel, and comment any advice or any queries you have. Thank you.